Hi, everybody. Barry McGuire here for Barry McGuire's Creative Real Estate Education Program. So we got through the door a half an hour ago. Just came back from a great visit to Saskatchewan, where we visited my sister Mary Beth and her husband Richard at their farm, and we were out to the Connaught County Annual Fair. That would be the 108th Connaught County Annual Fair. And so I bring along vegetables and things from my garden, and I compete against my brother-in-law Richard, and we try and kick each other's butt. And him being a farmer, I think he more or less kicked my butt. But I got a first for raspberry jam, which Donna posted, and if truth be told, she cooked that. So let's just, full disclosure. Although I asked her to, I think that's important. And I got a first for garlic, and I got a first for potatoes, and I got a couple of seconds and thirds. So that was a lot of fun. It was 2 beautiful days. Worked in the hamburger booth on the cash side, corral people into buying hot dogs and French fries, and watched the horses and the kids and the baseball tournament. And it's just 2 days of fun. So we were out there on Friday, and we got back today. So thanks to Richard and Mary Beth for hosting. And now today, we are doing the last in our series on private lending. As folks who watch this show know, we try to help people with all things on the creative real estate side of things, agreements for sale and rent to own, and wholesaling, fix and flip options, joint ventures. And to do that, we bring in various people who understand facets of creative real estate. We have certainly mortgage brokers and other finance people, lawyers on the foreclosure side, appraisers, insurance adjusters, or insurance agents, developers, anybody who can help with the subtleties and nuances of creative real estate, because there's, like any strategy, there's lots to learn. So we've been doing private lending for the last 4 or 5, 6, Donna says.
We're at number 7.
Or the Monday main event. So this is number 7 in our series on private lending for the Creative Series Monday main event. And today I'm delighted to welcome Babette Turner to the show. Babette is an Ontario lawyer. She practices in Ottawa. She attended one of our very first rapid cash programs in Ontario to learn about those creative strategies, and she has been implementing ever since. So I'd say she's really leading the charge in Ontario, and more recently assisted by Melita Cardinal of Cardinal Law, and Melina's lawyer. She's got a couple of lawyers there who came to our agreement for sale event in Toronto in April. And Antonio Domino as well. I've been working with Antonio since he was in law school, and now he's a lawyer, and he's also a big participator. So we've got an Ontario presence, and we've got Ontario people. And so I thought it would be useful to have Babette on today to talk about private lending, because she is doing private lending, and I think a fair bit of it. And in the midst of talking about what Babette sees on the private lending scene in Ontario, we're also going to talk about some other little, as Donna said in her preamble to this show, the nuances and subtleties and rabbit holes of private lending. And there's been some recent legislative changes on the criminal rate side of interest. So Babette's going to talk to us about that. And then we'll have some finishing comments on syndication. So without further ado, Babette, welcome to the show.
Thank you. It's good to be here.
Thanks for coming. I know you're a busy person and getting busier all the time with, folks, Babette works hard at her business. You all might have creative real estate businesses. Babette has a legal business that she started from scratch and is building up by working hard and attending events and increasing her knowledge. And she's doing for herself what you all should be doing for yourselves. So she's doing it for herself as a lawyer and also as a creative real estate investor, which she is.
Yes.
So she's like doubly working hard here. So
I did my first RSP mortgage before I was a lawyer, because I've been in the investor cycle for a while, and I was going to different networking events, and I had actually done my very first RSP mortgage out of my RSP funds before I became a lawyer.
Oh, you were a lawyer. Good for you.
Out of TD Canada Trust when they still allowed you to do it.
And they still did it. Yeah, TD doesn't do that anymore, but they did back in the day. That's true.
Yeah.
They did back in the day. So, Babette, we always like to, I know you watch the program, we always like to let our guests give us a little bit of bit of background about who they are, how they sort of progressed in life through jobs and schooling to get to where they are. You're a lawyer now, and an investor, but you weren't always that. So give us a little lead up, and then tell us about your practice before we get into what you're doing with private lending within your practice.
Sure. So I came from an IT background, so doing database support. And then while I was doing that, I started hanging out with different real estate investors, different networking groups, RAIN way back when, Ottawa Real Estate Investors Organization. So about 15 years since I started going to those meetings. Had a small investment. And then like a lot of investors, they tend to go out and become realtors or mortgage brokers. I went off and became a lawyer. I knew that it would have been much more intelligent to take that law school money, the tuition, and invest it in down payments and do passive income, but that wasn't my path. I tend to be the bumblebee path where I this is a straight line, this is my line.
Yep.
But I have a lot of fun along the way. So I went to law school and then did my articling, and I was a mature student when I did it. And I was working part-time and going to school full-time, or full-time to school and part-time work. So it took me a little longer to get through it all. So I did the 3 years program, and then I took a year to study for the bar while working full-time. And then I did articling while working part-time for my other job, and then decided that it made sense to open my own practice because I thought I was too old to start as a junior, and I wasn't going to be able to I had so many years of work experience that it just didn't make sense for me to go work for somebody else. So I started slowly, you hang your door up and then you start networking and looking for clients. And my very first, I started in 2015. I opened my practice at the end of 2015. And I did my first RSP mortgage for clients in 2016 as a lawyer.
Good for you.
Yeah. And almost all of the mortgages I've done in terms of registered funds have been through Olympia Trust. I did try to work with other companies throughout the years, but they were much more difficult to work with. And I was never able to get all the way through. Not me, but getting them to answer the phone, getting the answers I needed, everything. So Olympia is pretty well the one I've been working with the most. And I've been doing that since 2016.
Okay. Well, and just a sideline there, we've talked about registered plan mortgages. Stuart and Denise McPherson went on, and we alluded to that previously. And back in the day, there were a number of entities, including TD, that said they did RRSP mortgages. But folks, it was just like Babette says, they were impossible to work with. They didn't do very many. They didn't really have a program. They weren't really interested in. They didn't monetize it properly. So as soon as banks aren't making money, they don't really want to do it, but it took them a long time to get out of it. Actually, we're pretty grateful that most of those trustees, the trustee arm of banks, we're grateful that most of them have fallen by the wayside, because really Olympia is the main RRSP or registered plan trustee across Canada. And they do have a good program, and they have monetized it, and they have increased it, and they have done a bunch of things. So that at least is a bonus for anybody who's doing registered plan mortgages now, is that Olympia is running it to a great extent, and they do a pretty good job. So that's good.
Except for when they change in the middle of a deal.
Well, yes. Now, that's one of the things that we've always noticed about registered plan lending, is that you cannot depend at all on what the rules were the last time you did one, including, well, I guess, Babette, you're saying from when the time you started a deal till the time you finished, they changed rules in the middle of the deal.
I had given Olympia Trust all the documents that they required for a recent deal, based on, using their portal, because before you do it on paper forms, the MPA, the MID was, and you'd send it off to them in paper forms. Then they introduced the portal. So I'm using the portal. Everything had been completed as per their previous instructions. But that morning, that morning they changed their rules. They said, we now need shareholders registers as well. So when I went to the other lawyer on the other side, they're saying, why didn't you ask for this in your acquisition letter? And my response was, I didn't know I needed it until this morning, because that's when they changed the rules and that's when they told me about it. So occasionally that happens. It's happened like each time the Olympia's made a change. They haven't been really proactive in terms of announcing it. You sort of find out when you go, oh, we can't do this anymore.
Yeah.
Other than that, they're really good to work with. Like, other than the not being proactive and telling us of the changes in there, what's happening and how the things are going to change, and they kind of hit you like by surprise. Other than that, they're really good to work with.
They are really good. And we don't want to dump on Olympia too much. That's pretty common for lenders. They change a policy and you never know until you're doing a deal with the new policy. And then they go, oh, yeah, we changed that. So, but that's the way it is. That's the way they all are. We just have to live with it and realize, I mean, we should advise our clients that there's the possibility that might happen. So,
and because of that, very often, I'm not sure if you covered any of your other calls, but because of things like that, we try never to close like an Olympia Trust financing on a Friday. Because of the time zone difference, we get money late in the day and sometimes not in time for closing. I have on more than one occasion received funds from Olympia on an RSP mortgage after 5 o'clock Eastern time, which is our time for closing our registration system. So if that was to be a Friday, that would be 2-3 days delay. So we try to have everything arranged so that we're only advancing funds on a Thursday. And if it's a purchase, sometimes we ask the lenders if we can advance 1 day early. That way we have the funds in our trust account in time for closing. So that's a trick we do frequently. Say we'd like to request the funds 1 day early. There's a small interest adjustment, but that interest adjustment is usually a lot less than having a delay and paying extra fees for extensions, et cetera.
Yeah. Actually, so that's good coaching. Try and close deals on Thursdays to give yourself the Friday, for not just for Olympia, but generally speaking, to give yourself, stuff happens, right? Stuff happens to delay things. So if you give yourself an extra day, we've now taken to, just because things are so delayed out here, funding things a day early and sending money a day early and saying to our clients, it's just cheaper than missing and having problems on that other end. So I think we're agreed on that. But Babette, tell us about
I just wanted to make one more comment.
lending.
I just want to make one more comment about that. Is that something you could do with private lending that you can't do with regular, like from TD, RBC, CIBC? You can't say, give me the funds a day early. But with private lending, you can do that. So that's great flexibility in private lending.
Yeah, that is. So apart from in your practice, so you're doing, it sounds like a fair number of registered plan mortgages. Are you doing other private lending deals where Bill wants to lend to Jim, or corporations want to? Tell us about that part of your practice.
So we have basically 3 types of private lending that our office helps clients with. One is the registered funds, Olympia Trust. One is cash, where a person has cash, and the other is a combination of the two, where some of the persons on the mortgage are coming with cash, and some of the persons, or it could be the same person. They could have money in their RSP and cash in their bank account, and they lend it together. So there's RSP, cash, and a combination of registered funds and cash, the 3 types of lending.
All right. And are you seeing a fair bit of demand on the private lending side?
There's always a huge demand for people borrowing, and there's a fair amount of money available from lenders, but we see a large demand on the from persons wanting to borrow money, private lending.
All right. So on the straightforward, it's a registered plan loan. There's not a cash component to it. Do you get any flexibility for, let's say you're on for the lender, and I guess through Olympia. Going through Olympia, the lender has money in their registered plan with Olympia. Has Olympia changed the rules at all on the kind of security that they want for a loan against the home? Let's say it's a basic mortgaging situation. What do they want for security?
So for Olympia, it has to be registered against a property in Canada. There are other things you can use your RSP funds like mix and whatnot. I'm not talking about that. There are other things that people can use to invest in using their RSP funds. But in terms of the private lending, it has to be registered on a property. Olympia Trust has a rule that it can be no more than 100% loan to value, and then they require evidence of that. So they require a copy of the current mortgage, how much is outstanding on the current mortgage, a current mortgage statement, which can be tricky if the first mortgage holder, if it's a second mortgage, and the first mortgage holder is a private lender, because it's more difficult to get mortgage statements from private lenders than it is from banks. But Olympia will allow us to use a recently advanced mortgage if it's within, it's either 3 or 6 months. If it's a recent mortgage that has just put on, Olympia will allow that. And then, of course, valuation of the property. How much is the property worth? So we're looking at either a recent agreement of purchase and sale, a MPAC assessment, which is a government assessment value that's used for city taxes, and then an appraisal. So one of those three to provide a valuation of how much the property is worth, and they won't allow any more than 100% loan to value.
Okay, so that is reasonably straightforward. That they want a mortgage. I mean, we see other transactions where lenders want mortgages and assignment of rents and security interests and environmental guarantees and indemnities and shareholder pledges and insurance assignments. And I mean, when you get into the more complicated loans, I mean, there could be 15 or 20 bits of security that the lender wants, but Olympia really just sticks to the mortgaging side, don't they?
That's with Olympia, but as the lender as the lawyer for the lender, there's other information I also require.
Okay.
Obviously, I require the fire insurance to be made out in trust for my clients. I usually get title insurance as well to make sure they have valid title. I also require, if it is a corporation, a copy of the articles of incorporation and a corporate bylaw of borrowing. And if it's a rental property, I'm going to ask for a notice of assignment of rents, because I'm protecting, if my clients are the lenders, I'm protecting my clients. So even though it's not required by Olympia, I still require those documents to protect my lender.
Yes, which of course is wise. Just because they only want a mortgage, it doesn't mean you have to ask for 20 things, but those other items you mentioned are all pretty basic things that as the lawyer for the lender, you would really want to see those and make sure they all line up. Now, just before we carry on, I see that my sister Mary Beth has come online a few minutes ago. So hi, Mary Beth. I was telling everybody at the beginning that we visited you and Richard out on the ranch and what fun we had. So you can go back and look at that after the show to see what I said. But thanks for coming on and watching, and thanks for having us out at the farm. That was great. So Babette, back to you. Now, when you're on for the lender and they come and they say, okay, Babette, this person has a property. It's worth $800,000. They've got a $600,000 mortgage on it right now, and I've got a spare 200, and that's what they want. So it's worth 800, first of 6, and they want to put a second on for 200. And they go, yeah, and we actually got an appraisal, and our place is worth exactly $800,000. Mm-hmm. So now that satisfies Olympia, and there can't be more than 100% loan to value. What do you say when a client comes in and maybe they're not too sophisticated? If they say that's the deal, do you talk to them about what you think about that?
I do, but I don't get very many unsophisticated clients. Most of the times they're investors that are lending to other investors, and they're very sophisticated. Mm-hmm. However, if they are unsophisticated, I will go over the concept of loan to value and the risks that are involved. And if anything does go wrong, that like they may lose part of their principal because there won't be sufficient money after all of the enforcement activities if anything happens. But typically when it's for persons that are less sophisticated, they don't usually go 100% loan to value. They're not comfortable. They don't feel safe at that. So they'll go 75, 80, possibly 85% loan to value. Mm-hmm. In most cases. It's only the ones that are very sophisticated, and they're typically lending to fellow investors because they're very familiar with them.
Yeah. Okay, so I think that's kind of how I do it too. I mean, no matter what, I say, okay, this is 100% loan to value situation. If it's a sophisticated person, I go, so why are you comfortable with this? And as you observed with your clients, investors, experienced investors, have reasons why they're comfortable, and if it makes sense, that's fine. If they're not sophisticated, then you have to have much more in-depth conversations on the risk that they're taking by doing something that a lender wouldn't do, even if they were insured with CMHC, they wouldn't do 100% loan to value. So if banks won't do it and they're insured, you better understand why you should do it. So folks, if you're listening and you want to do a registered plan loan, and you realize Olympia will allow you to lend up to 100% loan to value, just look, I want you to be really comfortable with why you would do that when the bank won't. As Babette says, we all have clients who are quite comfortable doing those 100% loan to value ratios, as long as they're experienced, they really understand what the deal is, they understand the people, they've done some underwriting on the loan. And last week, I think we got a pretty good lesson from the guys at Calvert Home Mortgage on the things that they look for as an extremely experienced lender in the higher risk space. So you got to underwrite. All right, let's look at what Martina says. How often do you really see 100% loan to value deals?
Almost never. Almost never. Occasionally, but almost never.
Yeah.
Right.
I've seen about half of mine in the last while have been 100%.
Yeah.
Which makes me nervous, but.
Yeah, I don't see that many. All right, so it also depends on the project itself. If a person's going to be doing a flip, for instance, they're saving their capital to increase the value of the property. So it starts out as 100% loan to value, but very quickly becomes like 98, 95, 90, 85% loan to value as the value of the property is being forced because the investor is bringing their money to the deal. If it's a wholesale deal that is below market value, it could be that there's already intrinsic value in there already. So usually when they're 100% loan to value, they're not long-term, they're not very often, and there's very specific types of deals that those are for. Most are in the 70 to 85% loan to value, I would say.
Okay, well, which certainly is safer for the lender. Don, I'd like to go back to that one Facebook user comment about how you have to take into account the line of equity portion of a mortgage.
That's Denise.
Denise. Oh, good. Denise, thanks for pitching in. So Denise says people forget when they ask the proof of first mortgage, which often we're doing second mortgages here. If there's a line of credit also with that mortgage, it will reduce the amount of equity available for you on the second. So I think what Denise is saying is that if that first mortgage has a line of credit component that has not been advanced, that will still get counted. Do you think that's what she's saying, Babette?
I think so. I think it definitely should be considered when you're doing loan to value, because they could advance that. They could request the extra funds, and now they have more than you originally thought they would. So I believe that should be accounted for, is the equity that's available, not just the amount that's currently outstanding. So it depends on the type of mortgage they have. Fixed mortgage, it's the amount outstanding. If it's one of those like Scotia Plan step mortgage and they have several thousand available to advance afterwards, you want to consider that as part of the first mortgage in terms of doing your loan to value.
Okay. All right. So that's good for people to know, because the plain vanilla mortgage, where when a bank lends, they just take a mortgage, at least in my practice, that is becoming a creature of the past. It's almost always those hybrid primary security with a HELOC and collateral land mortgage in support, and step mortgages are common. You split the actual amount lent against the property and the amount that might show up in a line of credit, and they're quite complicated, and so those are far more common than the plain vanilla mortgages. So that aspect might come up a fair bit when you're looking at the loan to value side of things. Okay. So, Babette, before we get on to some conversation around the recent changes to legislation around criminal rates of interest. Is there anything else you want to say about private lending generally that you see in your practice that you think some of our folks should be aware of?
I think it's probably been covered in some of the other sessions, but the flexibility that you have in private lending, in that you could pick monthly, quarterly, annual. You can split your interest, part of it being a balloon payment. So if your interest is 15%, you could have 8% a year paid annually, and the other 7% at the end of 2-3 years, whatever the overall term is. So it gives the borrower more flexibility, especially if it's in a registered fund where the lender's not going to be using the money anyhow. But so I tend to see that if it's in a registered fund, the lenders are less concerned whether they get an annual payment, whether they have a split annual payment and Olympia Trust requires the minimum to be once a year at the prime rate of Canada at the time the mortgage is advanced, Bank of Canada prime rate. So if it's in a registered fund, people care less if they're getting it all at once. But if it's cash, people tend to want the monthly payments. So I do see that preference. If I'm lending you cash, I want monthly payments. If it's in a registered fund, give it to me once a year. Give me split where I get the balloon payment. I see that a lot.
Yeah, that's true. The private side is a lot more flexible, and people, if their money's in a plan, it's just staying in the plan. It's not that they need it. I mean, part of their concern is as they consider what payment kind of style or length to take is just making sure that people are going to be able to make those payments. It doesn't come to the end of the year or the end of the mortgage and they go, oh, well, that didn't quite work out. All right. Question. Does it mean that it's better to open a line of credit before or after you're approved for private lending? Well, I mean, what do you think, Babette? If you have a line of credit open before you do your loan and it's attached to an existing mortgage, then the unadvanced portion of that line of credit is going to get taken into account in the calculation of the loan to value. If you just open a line of credit, I'm not sure if that gets, well, if it's secured against the property.
So if it's unsecured, it may not matter because you're not looking at that. If you're lending and you're registering against property, you care about the equity that you can secure your loan against.
Yeah.
So if this is an unsecured line of credit, the bank may have a preference. The other thing is private mortgages tend not to show up on credit bureaus, where traditional ones are now showing up on credit bureaus. But I haven't seen any private ones. Like if I register Olympia Trust, I don't see that showing up on a person's credit report. So if you look to get your line of credit afterwards as an unsecured, you'd probably still be able to do it. So I don't think it would make a difference.
All right, Babette, let's move on to the changes in legislation. So folks, the Criminal Code of Canada has a section that talks about what interest rates people can charge and what happens if you get over the interest rate that the criminal code says you can charge. If you get above it, what happens? So Babette, if you could give us a bit of a primer there on what it used to be and what it is now, and then we can move into how that can be dangerous and people have to watch out for it.
Okay, so to prevent usury and predatory lending practices, the Government of Canada introduced an amendment to the Criminal Code in 1980, and at the time the Bank of Canada rate was 21%, and the criminal rate was introduced at 60%. Now there were exceptions made for places like payday loan. So payday loan is excluded, and they can still charge the amount that they're charging, which is $15, $100, ends up being 391% interest per year, and they're excluded from it. But other than that, the criminal rate was 60%, and it was recently reduced to 35%, and that was June 22nd. Like, it's gone through readings over the last couple of years, and I believe it was received assent in June 22nd and became official as June 22nd this year. So the criminal rate is now 35%. Now that would be considered everything. So you say, well, the interest rate's only 29%, and then you charge them $10,000 in admin fees. It's everything that can be added up at the time of the loan. So any admin fees, lender fees,
Broker
prepayment
fees.
interest. I'm not sure about the broker fees, possibly. It wasn't enumerated as one, but they did say all fees, anything that could be interest. So that one I'm not sure about. And so what happens if it's over the criminal rate is if they take you to court and say this was over the criminal rate, you would probably have to pay back all the interest that you've received. Most of the court cases show that you're paying back all the interest you received. But not the principal. You're not unjustly rewarded, so you're not getting to keep. If you advance 200,000 at the criminal rate, all the interest you earn would be paid back, but you're still able to claim your principal if you're going against them. Most of the court cases have been in that mode. There are other court cases that where a person defaulted on their mortgage, for instance, and because of the fees involved and the penalties, the prepayment penalties, it would have been over the criminal rate. But the borrower can't put themselves in a position of creating a criminal rate. So the borrower can't do something by their own action that puts them into that position. So in those cases, so if a person defaults on your mortgage and say you have 15% interest for a 5-year closed mortgage, and after 1 year they default and or they decide to sell the property and want to pay off the mortgage, you can claim the interest for the remaining period of time because the borrower is the one who forced the interest to go over and above the criminal rate by their own action.
Okay. So that, that's understandable. The borrower gets themselves into quite a high interest rate mortgage with high payout penalties and high this and high that. I'm always amazed when I read the schedules to private mortgages that come from private lenders at big firms. There are a lot of things listed as fees that can be charged for items that the borrower might be offside on, that all of those would get added up. But nevertheless, you can't put yourself in default or be offside the mortgage and then say, hey, well, you did it to yourself essentially. So
basically, yeah,
you're going to have to pay. But on the other side, when it isn't a payday loan company and when it is one of those mortgaging situations, so I think what we're saying people have to watch out for is if you've lent at 15 or 18 or 20%, which is, that happens. I think now the Calvert people, what did they say their top rate was? 18 point. I think they said it varied from 9.99 up to 18.29. So that's getting up there. And if you had a
lender fee, add-on lender fee, some people will charge like a 5 points lender fee, which is over a year, 5 points. But if it's a 3-month mortgage, that's 15%.
Yeah. So what we want you to hear is that you should sit down and look at what you're charging. If you're lending money and you're lending at a higher rate of interest and you have lender fees and other fees as part of your loan package, and lots of people do, and there's nothing wrong with that. You just have to sit and go, okay, what happens if my borrower defaults and I'm looking to claim this interest? Am I going to get myself cumulatively over the 35% mark so that my borrower can go off to court and the court will say, oh, look at this, you're 37.5%. So you can have your $200,000 back, but you can't have any of your 18% interest. You can't have your $10,000 lender fee, and you can't have your $5,000 admin fee, and you can't have any of those other things. You get your principal back is probably a pretty good rule of thumb.
And if you've collected the fees, you have to pay it back to the borrower.
Yes.
So that's like out of your pocket back to the borrower.
Right. The interest fees.
My comment about the criminal rate is if you have someone that's willing to borrow at that rate, maybe you shouldn't be lending to them. Like, yes. If someone's willing to pay like 25, 30% on a mortgage, they have to have really good reason. I probably would say you probably don't want to lend to a person that's willing to pay that rate.
Yes. When you get up in that category and over, the illegal lenders, the guys who come along with baseball bats to collect their loans, they are lending at 200% and 300%. But let's not be doing that, folks. Let's not get into that category where you have no way of collecting. If somebody wants to borrow at that rate, boy, you got to underwrite that loan really hard to know that there's some good reason for you to be doing it, because often there wouldn't be. All right. So Martina says, are the lender's legal fees part of this 35%? That's kind of on the same side as is the mortgage broker fee part of, and I don't know that, Martina. Do you have a sense of that?
I don't know. I suspect they wouldn't, but I double check and I will update on your group posting. I'll double check that.
Double check for
They say all fees, and it's left kind of open. It's not enumerated like this type. Mm-hmm. Definitely the admin fees, definitely like the lender fee that you're adding on top of it, definitely the prepayment are all listed, but the legal fees and mortgage broker fees were not listed. So I'd have to verify with some of the cases and see how they were handled.
See how they go. I think one thing that might come into a consideration of that is what is the legal fee on the loan. I've certainly seen that the fees that some lawyers charge when they're acting for private lenders are much more than they would be charging if they were acting for a bank and someone's just buying a house with a regular mortgage. They're often double, and sometimes I think it's just taking advantage of a situation where the borrower doesn't have any choice. They need the money and they just have to pay whatever it takes. Now, I don't know if that's exactly true, because I don't know what's going on in those legal offices, but sometimes I look at it and go, looks a little high to me. Any other coaching on the criminal rate of interest side of things and in this particular area?
No, I did have one loan that came to me and I said, you can't do this loan, but I've never had anybody come that high before. One did come to me actually a few weeks ago, and I said, you can't do this. I can't do this. Great interest. Love to make that much money, but nobody can do this loan because it's criminal. Yeah. It was a short-term loan, and when you took it over the whole year, it was like over the limit. Yeah. But no, not really. Other than just, I can't see anything going, like anybody willing to pay that much money. I would be avoiding. So, yeah.
Okay, there's Babette's underwriting coaching on the high interest rate notion. When you add it all up, if it seems like no sane person would pay that, maybe the loan shouldn't be done. So, yeah. All right. So. What else, Babette? Before we get into syndication, did you have any other?
The borrower pays usually. The borrower is the one who pays the legal fees for the borrower and for the lender, so that when the lender is looking at their rate of return, they're getting the interest rate stated. Yeah. So if I'm lending at 8%, I don't have to calculate, okay, I'm going to pay $12 a month or $15 to Olympia, and this is going to be my actual return. It's going to be the return that we state, because the borrower is going to pay that. They're going to pay if it's Olympia, they're going to pay the monthly fees for Olympia, usually at the end on the discharge. But so the fee that the rate that the lender quotes and is getting is usually what they're getting. It's the actual rate, unless of course there's a default or something. But other than that, that would be the rate they're getting. A couple of differences in don't commit until the funds are available to lend. I've had this happen a couple of times where a borrower and a lender knew each other, and the lender was going to lend and they were going to move their funds over to Olympia Trust. And in two separate times, it's taken over 2 months to get the funds over. Not because Olympia is great. It was the institution that was losing the money that had to give the money up and over to Olympia Trust on a transfer, because you don't take the money out of your RSP ever. It has to go from institution to institution. So there's paperwork that has to be filled out, and you request the funds to be transferred to Olympia. So in two separate occasions, it took over 2 months to get the funds. So if the person had committed and a person was going to be buying a property a couple of weeks later, the funds would not be there. So I usually ask people not to, until the funds are actually at Olympia, commit, because and it did happen where one person had to scramble to find another lender because at the last minute they found that they weren't going to have the funds. It's just better to wait till the funds are there. Don't commit until you know the funds are available for lending.
Okay, so folks, just so you're understanding this, if somebody has their money in an RRSP at TD or RBC or CIBC or any place like that, and they go, "Hey, I'm gonna transfer all my mutual funds or my cash to Olympia Trust," the institution losing the money is not motivated and enthused about jumping on it as their first priority. I'm not saying they deliberately would delay it. It's just, I mean, I think it's kind of human nature. Yeah, certainly. Yeah, that's your right, and I'll get that money over. But I've got about 20 things ahead of you on my desk, and so it can take a bunch of time. So that's good rule. Don't commit to lend until you actually have the money in your Olympia account, and not the mutual funds, the money. You want the cash in the account because that's what you can lend.
Right.
So that's good, Babette. I like that. We have another question before we get on to syndication.
It blocks you guys both.
All right. Yes, we can't see each other because we're looking at the question. When you have a registered union employees pension plan, can it be moved into an Olympia Trust account electronically and be able to start a private lending right away? It's better to wait and leave it there for a while and then start a private loan after a while. Would there be any difference for a lender? What's the rule around that for a new account holder? You know, Babette, I don't really know. I can't comment on that.
All right. So if you're allowed to move your registered funds somewhere else, so it depends on the fund that you're in. Like some registered plans can't be moved. So if sometimes you'll have a job where you have dollar matching, and the employer will match you, but it's not vested, so you can't move the funds yet, or the funds are in the account and you're allowed to move them at any time. So it depends on the rules in terms of the pension fund that you have, whether you're allowed to move it or not. That part I can't answer to because each pension plan is going to be different. So if your pension plan allows you to move it to another institution, and it can be any institution like TD or CIBC or anywhere, if you're allowed to move that, then you can move it to Olympia Trust, and you can lend as soon as the money's in the account. Like, you don't have to wait. As long as you're allowed to move the money to Olympia Trust, you can lend at obviously not the day that it gets there because we have to get the paperwork and everything done, but very shortly after. You don't have to wait once it's Olympia Trust. Now, like I said, some pension plans you're going to forfeit possibly employer matching if you move it too early. I don't know what your particular plan is. You'd have to check with your pension fund manager to see if you're allowed to move the fund yourself, the funds in it that are yours. But new account holders, there's nothing about different between Olympia Trust old account or new account.
You're good now.
Oh,
I hope that answers the question. I'm not sure if that's what they're asking or not.
very good. I think that's it. That's it. Check with your pension fund manager for any situation that was just mentioned in that is really good advice. Okay, so let's move on to part 3 of today's show, which is syndication or syndicated mortgages. So tell people what a syndicated mortgage is, what syndication is for folks who don't know what those words mean.
Okay, so in the private lending world, syndication is very simply multiple people on the same mortgage as lenders at the same terms, same conditions, same priority. So instead of me lending you $100,000 and my cousin lending you $100,000, I would be first, they would be second. I can lend you 100 and they can lend you 100, somebody else can lend you 50, and all the funds together are at the same priority on the same mortgage. So I would say if I have 100,000 on a mortgage, that could be like 35% of the mortgage. Somebody else could be bringing in 50% of the mortgage. So we have a portion of a piece of pie, and that one pie is one thing. So I'm lending the full amount, and it would usually be the same term. Often it's a first or second mortgage. So people prefer this in that the borrower can get a larger chunk of money to borrow in one sum. And if it was done differently, where each person had to go on their own and be registered, you would have a person in first, a person in second, a person in third, a person in fourth, if you have 4 people, for instance, where if you put them all together on the one mortgage at the same term, it would be 1 year, 2 years, whatever the term is, the same interest rate and the same position, you could have all 4 on the same one mortgage. And that would be what we call syndication.
Okay. So folks, when Babette is talking about for individuals, each lending, and someone would be in first position, second position, third position. What that means is the person in first position, if you look at the title for the person who's borrowing, the person with the first $100,000 is first on the title. And that means, again, the person who lent second, if you look at the title, their second registration on the title. So if the mortgage goes bad, the person in first position is in the best position.
Mhm.
If the loan is $350,000 and they've lent $100,000 and you have to foreclose on it, likely the person in first position is always going to get their $100,000. The person in fourth position who lent $50,000, may not get their 50.
Yeah.
So syndication allows more people to get together and put together a loan in a way that the borrower doesn't really mind, but the lenders feel much better about, because they are all in the same lending boat together. And if the mortgage goes bad and foreclosure happens, they all get their individual piece of the pie without somebody losing out completely. So it's a vehicle to let people get together and lend money secured by a single mortgage where they all have the same priority. So now, having said that, that's a useful thing to do for the reasons that we've said, there's been some changes in the registered plan syndication side of things. So tell us about that.
So previously, one lawyer could represent multiple lenders on a registered mortgage through Olympia Trust. Olympia changed their rules. It's not the law, but Olympia Trust rules. They've decided that they've implemented this is their internal rules, and this is how they operate. If you have one person on a mortgage, and that person can have multiple accounts, they can have a TFSA, they can have cash, they can have an RRSP. That's one person. A lawyer can do that. If it's 2 to 5 persons, then you need to have a mortgage broker involved. If it's 6 or more, then a mortgage administrator needs to be involved. So the more persons involved, the more fees, of course, and the higher the expenses. So it gets to a point where at some point you might be better off just going to a different body to borrow money. If you're paying for a mortgage broker and a mortgage administrator, or a mortgage administrator that does both. And those are rules by Olympia Trust. The one thing, caveat, or I guess exception to that, would be if it's a husband and wife, legally married, they count as one person.
Oh.
So Olympia says that they count as one person. So I can have like somebody with cash and somebody they're married to with RSP funds, and Olympia will allow that.
Okay. So then for that first category of 2 to 5 people on a mortgage broker has to be involved. So the husband and wife count as one person, not 2 people. So they don't need a mortgage broker. They can just deal with Olympia and their own lawyer.
Correct.
Okay. Now, what things are the mortgage broker and the mortgage administrator doing in the 2 categories of 2 to 5 and I guess 6 to 10? What's the broker doing for the folks in the 2 to 5, and why is Olympia getting that broker involved?
Olympia is getting the broker involved because there were problems before in the private lending sphere, and people may have heard of it. And so right shortly after that, Olympia added these new rules to protect themselves. When mortgage brokers are involved, there's a certain amount of errors and omissions that mortgage brokers have. And I believe Olympia made the decision and the choice to require that because they would have better protection if a mortgage broker was involved. There's certain types of disclosure mortgage brokers are supposed to do. I believe it's called a Form 1 disclosure. There's a Form 1 for the lender and a Form 1 for the borrower. And it describes the details of the mortgage, the fees involved. It's a breakdown. It's a description of, and it describing it. And if a mortgage broker is involved, I understand that their errors and omissions would kick in. It would probably protect Olympia Trust.
Okay, so I think Olympia was getting a lot of flack when mortgages were going bad. People were looking at Olympia to say, you guys should have known about this. You should have told us. You should have, despite the fact that Olympia makes it very clear they're not giving any advice on the loan. Still, people take a shot at them, and then you have to defend. And and it's time and money. And so Olympia's kind of putting up a wall saying, all right, we're a trustee. We're not a mortgage advisor. Your mortgage broker can advise you. And so something I'm not clear on, Babette, is when a mortgage broker has to be involved, or an administrator, and they look at a loan, people come to them and say, okay, we're proposing to put together this loan. Does the broker have the power to say, you know what, this is a bad loan. We're not going to approve this because it's got so many holes in it. I mean, we're experienced. This doesn't make sense. We're not going to let you do this. Can they do that, or how much power do they have in here?
They probably could, but they don't, because they don't have to do any work. Okay. So first of all, the whole deal comes to them. They just have to like fill in the paperwork. And the borrower and lender have already made arrangements and have committed to each other and lined it all up. And if that mortgage broker doesn't do it, they'll get to add their fees, and they don't have to go find the lenders to give to the borrower. It's a lot less work for them. They still charge money for it. They still charge a fee for it. I've seen the fee for most mortgage brokers tend to be 1% or $2,500, whichever is greater. So a $100,000 loan would be $2,500, and a $500,000 loan would probably be about $5,000 in fees. That's what I'm seeing from mortgage brokers. Mortgage administrators tend to be in the 2 to 3% range. And they work differently. And I know of one mortgage administrator, and I don't know their fees, but I know that they will not do a deal unless a mortgage broker is involved. So there's one administrator that says they will do it, but only if a broker is involved.
Yeah.
So the fees might be lower. I don't know. We didn't have that discussion.
So now we have a mortgage broker and a mortgage administrator. And that goes back to your comment that this has added a whole new layer of fees in this private lending process that can lead to a circumstance where the loan just doesn't make any sense anymore. So much is taken away on the fee side that on the administration and the brokerage fee side of things that it just doesn't make financial sense to do it.
Yeah, because you might get a similar, like if you go directly to one of the MICs, you might get a similar rate.
Yeah.
As opposed to, yeah.
Yes. So that's something to consider. And I've been doing registered plan mortgages now for, 20 years or so. And the rules and the regulations, and as we talked about them changing the rules in the middle, the rules have changed a lot. It was really, really easy in the early days of registered plan mortgages to put these deals together. And it's become increasingly hard. And the reason is that Olympia was getting shot at by unhappy lenders who think Olympia should have protected them, where it really wasn't Olympia's problem or fault. No. But doesn't stop people from suing. As Babette, as we tell our clients often, when somebody says, can they sue us? When your client's so totally obviously in the right and there's no chance for somebody to win a lawsuit, you go, yeah, they might not win, but that doesn't matter. They can launch the suit and you might have to defend. So that's really, I think, what Olympia was doing, was just protecting themselves and getting back to their business of being a trustee with a wall between them and the lender on the exactly what are you doing and do you know what you're doing side of things. Okay, a couple of comments coming up here. When we borrow, we also pay all the Olympia trust fees, administrative fees related to the mortgage, besides the lender legal fees. As a lender, I expect the same. This means the lender gets a true rate of return, not an interest rate minus fees. Yes, that's right. Babette was pointing that out earlier, that when you lend, you want to make sure as a lender, if you've agreed you're getting a particular interest rate, that it doesn't get chewed up in fees that you have to pay. You want to get your true rate of return. So that's a good comment. And let's see, when you are part of the team as a mortgage qualifier, but not actually paying a monthly mortgage for a structural housing for a 16-month process, in case something goes sideways, reselling or other mortgage monthly payments, people can't cover a payment after agreement for being mortgage qualifiers. We're going to book the property still for sale after 6 months. Also, legal obligation will be sold. My goodness, that is a long, convoluted question.
Basically, if you are the qualifier, depending on how the mortgage was written, and they end up going power of sale, and it's sold, and there's not enough money. The mortgage qualifier, the person who's on the contract, is the one who's going to be coming up. The bank is going to go after. So whoever signed the contract with the bank or whatever can also, if there's a shortfall, be held responsible. So the qualifier would be the one. So you may as well pay because you're going to end up paying at the end either way. So the property is sold, and then the money is paid first to, I believe it's first to the realtor and then the lawyer. It could be the lawyer and then the realtor. And then after that, the funds are paid to the persons who lent the money. So it would be the lender's first mortgage, second mortgage, third mortgage, et cetera. And then any funds left over, at least in Ontario, power of sale, would go to the person who owns the property. So at some point, and then if there's not enough money, they can go after the person who is listed on the mortgage. So I would say probably the qualifier would be responsible to cover those monthly payments.
All right, Babette, thanks for that. Boy,
One
this
more.
is got one more question. I know a mortgage administrator for 6 people plus that charges 7% to handle the mortgage. Best in those cases to keep it to a max of 2 to 5 people. Yeah, wow. That loads it up there. My goodness, 7%.
That's a lot of fees.
That's a lot of fees. Yeah, you could be better off going to one of the mortgage investment corporations, the mix.
Mix.
That understand this kind of loan in Alberta and Ontario. Calvert Home Mortgage Investment Corporation is really good at these kinds of loans. They specialize. Yeah, you pay rates, but you get good advice, and they want you as long-term clients. We did our last private lending event was with them last week. We'll rewatch that one. Actually, rewatch the 7 that we did because they're full of nuggets on private lending, which is just, there's more and more of it. There's more and more. So Babette, thank you very much for coming on and giving us a hand here with how things are looking in Ontario and helping us with private lending comments generally, with the criminal rate of interest changes and what people have to watch out for, as well as some of these new syndication issues that people are running into. So this is the last of our series on private lending. Now, Babette, did you have one last comment there?
It's been a pleasure. And just to remind everybody that you're going to need the lawyer in the province where the property is located. So I have had lenders in Quebec that were lending on a property in Ontario. So it's the property where the province is, not where the lender is, but the property.
Where the property is. That's right.
Yeah.
I help a lot of Ontario folks who lend on property in Alberta. So you need a lawyer in the province where the property is located.
Yeah.
So everybody, we are just watching my sister Mary Beth say so many nuggets. Well, that's good, Mary Beth. I'm glad you were watching. You wonder what your brother does. He babbles on and on about loans and real estate, and I always wonder what you and Richard are doing on the farm. So I think it's mutual wonderment going on here. Last of our series on private lending, and Babette, I'm announcing here, and you're the first to hear it, Donna and I are taking the month of August off.
Wow, that's fantastic.
We are. We're going to take it off. I'm going to not be at work near as much. We got a big backyard. We got grandkids. We got stuff to do. And so we'll ratchet this up again in September. So everybody listening, Donna will certainly will announce this and talk about it a whole bunch more and make sure nobody tunes in going, where the hell are those guys, for the month of August. So that's an update. So Babette, thanks again for coming on, and
thank you for inviting me. Thank you.
We'll
Good
have you
practice
again another time.
Good practice for when I host my own podcast on private lending.
All right.
Absolutely.
Thank you
You
so
bet.
much.
Thanks, Babette. Good night, everybody.
Good night.
Good night.